If you're 62 or older and you need to tap into your home equity, you basically got two options: a reverse mortgage or a home equity line of credit or a HELOC. And most people don't understand the differences, which means they end up choosing the wrong one and losing thousands of dollars. My name is Emmett Dempsey. I've been doing mortgages for over 17 years, and reverse mortgages are one of my specialties. I work with a lot of retirees here in Florida, including a ton of military veterans. And this question comes up a lot. So let me break it down, show you all your options, show you the pros and cons, and help you figure out which one actually makes sense for your situation. Let's get into it. Let's start with the HELOC, because most people are more familiar with it. You see, a home equity line of credit is basically a revolving line of credit secured by your home. You can borrow up to a certain limit, pay it back, and borrow it again. Kind of like a credit card, but with your house as collateral. Now, the pros of a HELOC are pretty straightforward. You only pay interest on what you actually borrow. The interest rates are usually variable, and they're tied to the prime rate, so they're typically lower than credit card rates or personal loans. And you have the flexibility. You can use it when you need it and pay it down when you don't, and then use it again and again. Okay, so what are the downsides? You have to make monthly payments. And if you can't make those payments, you could lose your house. Also, if home values drop or your financial situation changes, the lender can freeze or reduce your line of credit. And it happened to a lot of people during the economic downturns in 2008. And here's a big one for retirees. To qualify for HELOC, you need income. The lender wants to see that you can afford the monthly payments. So if you're retired and living on a Social Security or a fixed pension, you might not qualify. Or if you do qualify, the payment might eat into your monthly budget more than you like. It's a classic problem that I see in seniors. They have amazing FICO scores, but their income drops in retirement. All right, so let's talk about reverse mortgages, because there's a lot of confusion and a lot of myths around these things. A reverse mortgage is a loan that allows homeowners 62 and older to convert part of their home equity into cash without having to make monthly mortgage payments. You see, you still own the house. You still live in it, but instead of you paying the lender every month, the lender pays you. Or they give you a lump sum or a line of credit, depending on which option that you choose. And the loan doesn't have to be repaid until you move out, sell the house, or pass away. At that point, the home is typically sold, the loan is repaid, and any remaining equity goes to your heirs. And I know this personally because I did one for my own mother before she passed, and I was on both sides of the table. I did her loan, and I was also an heir of a reverse mortgage. See, the most common type of reverse mortgage is the HECM, or the Home Equity Conversion Mortgage. And that mortgage is insured by the FHA. Because it's FHA insured, there are protections built into it. You can never owe more than the home is worth. Your heirs are never on the hook for the difference. And you can't be forced out of your house as long as you're paying your property taxes, homeowners insurance, and maintaining the property properly. One of the most popular options is the HECM line of credit. This works kind of like a HELOC, but with some major differences. You have access to a line of credit that grows over time. That's pretty crazy, right? The unused portion increases every year. And you don't make monthly payments, and you only pay interest on what you actually borrow. Okay, Emmett, so why doesn't everyone just do a reverse mortgage if it's so great instead of a HELOC? Because there are some trade-offs. So let me give you the pros first. Pro number one, no monthly mortgage payments. This is huge for retirees on a fixed income. You're not adding a new bill to your budget. The loan gets repaid when the home is sold. Pro number two, you can't be forced out of your house. As long as you're paying taxes, insurance, and keeping up the home, you can stay there for life. I mean, even if the loan balance grows larger than the home's value, you're protected because of the FHA mortgage insurance. Pro number three, the line of credit grows. So if you open a $200,000 HECM line of credit and don't touch it, the line will grow every year. It's like a safety net that gets bigger over time. Pro number four, there's no income requirements. You don't need a job. You don't need to prove monthly income. As long as you meet the age requirement and have enough equity, you can qualify. Now, you do have to have a financial assessment, but it's a very low bar, as saying you have to use residual income, kind of similar to the way VA loans use residual income. Pro number five, tax-free proceeds. The money you get from a reverse mortgage isn't considered income, so it's not taxable. That's a big deal for retirees trying to manage their tax situation. Okay, now the cons. Con number one is the upfront cost. Reverse mortgages have higher closing costs than HELOCs. FHA mortgage insurance, origination fees, appraisal, title. You're looking at several $1,000s in costs, though these can be rolled into the loan. And you can check out other videos on my channel that I've talked about FHA closing costs and why they're higher. They're not higher just because. They're higher because of the way that doc stamps and title insurance are calculated, because they're calculated off the appraised value, not the loan amount like other mortgages are. Con number two, interest accrues over time. So you're not making payments. The interest gets added to the loan balance. Over 10 or 20 years, that balance can grow significantly. Con number three, it does reduce your equity. The longer you have the loan, the less equity you have left in the home. So if leaving a large inheritance to your kids from home equity is a priority, that is something to think about with your family. Con number 4, complexity. Reverse mortgages are more complicated than HELOCs. There's required counseling, more paperwork, more regulations, and that's not necessarily a bad thing. I mean, those protections are there for a reason, but it's just not as simple as opening a HELOC might be. We can do it with a phone call and a quick phone call. It's just not as simple as opening a HELOC is. Okay, let's do a side-by-side comparison so you can see the differences clearly. Monthly payments. HELOC, yes, you have to make monthly payments. Reverse mortgage, no, monthly payments required. Income requirements. On a HELOC, yeah, you need provable income. On a reverse mortgage, no income requirements, but there's a financial assessment. Upfront costs. HELOC, lower costs, usually a few hundred to a couple thousand. Reverse, there is higher costs, several thousand, but it can be financed. Line of credit growth. The HELOC, it doesn't grow. The reverse HECM, it does grow over time if unused. Risk of foreclosure. The HELOC, yes if you miss payments. The reverse, no as long as you meet basic obligations like taxes, insurance, and maintenance. Equity preservation. On the HELOC, you're paying it down over time, preserving equity. On the reverse mortgage, the balance grows over time, reducing equity. Who's it best for? The HELOC, it's good for retirees with steady income who want flexibility and a plan to pay it back. The reverse mortgage is great for retirees with limited income who want access to equity without monthly payments. So which one should you choose? Choose a HELOC if you have a steady income and comfortably afford monthly payments. You want lower upfront cost and you plan to use the money short term and pay it back quickly. Or if you're younger than 62, reverse mortgages require you to be 62 or older, and preserving maximum equity for heirs is a top priority. You should choose a reverse mortgage if you're 62 or older and on a fixed income. You can't qualify for a HELOC due to income requirements, and you want access to equity without adding monthly payment. And you want the line of credit to grow over time as a safety net. And you plan to stay in the home long-term or age in place, as they call it. Here's a scenario I see all the time with military retirees. If you're 62 or older, you've got a VA disability income, and you want to tap into equity without impacting your monthly budget. A reverse mortgage might be the perfect fit. You see, your VA disability income doesn't count as taxable income, and the reverse mortgage proceeds don't either. So you're really in a very strong financial position. And one more thing for my Florida folks. Property insurance and taxes are going up here. If you're retired and a fixed income, adding a HELOC payment on top of rising homeowners insurance, it can get tight pretty fast, guys. And one more thing for my Florida folks. Property insurance and taxes are going up here. If you're a retiree on a fixed income, adding a HELOC payment on top of rising homeowners insurance can get tight pretty fast. A reverse mortgage takes that monthly payment pressure off. You're still responsible for taxes and insurance, but you're not adding a new mortgage payment to the mix. If you set up a HECM line of credit and don't touch it, you've got a growing safety net for future expenses and things like insurance hikes, medical bills, hurricane repairs, or whatever comes up. Bottom line, both HELOCs and reverse mortgages are tools. The right one depends on your age, your income, your goals, and your situation. If you're a retiree here in Florida, especially if you're a veteran, and you want to talk through which option makes sense for you, go ahead and reach out to me. Go ahead and book a call on my calendar in the description below. I specialize in reverse mortgages, and I work with a lot of military retirees. And I can run the numbers with you so you're making the right decision so you can see them side by side. You go ahead and drop a comment here in the description below or send me an email, or go ahead and book a call on my calendar. I'd love to talk to you. And if this is helpful, you can go ahead and hit that subscribe button because I break down this kind of stuff every week. Thanks for watching, and I'll see you on the next one.